Okay, well, uh, we're gonna start class off just by working on this practice problem. Um, we did this first one with specific identification, the one with the bikes. This one is with milk. Okay, so you can see here you have both purchase and sales transactions. The purchase transactions are all at different prices. So, we're going to use this same set of transactions, but we're going to apply the three different methods that we talked about: FIFO, LIFO, and weighted average. Um, and so it's the same setup with this table as we saw on Monday. So you'll have the date of the transaction, and then if it's a purchase transaction, you're gonna use these. Sales transactions will use these for calculating cost of goods sold, and then you'll have like a running balance of your quantity on hand. Okay, so it's the same setup. So why don't you guys just start off, see how far you can get with this, and then we'll do like one at a time. So do FIFO first, and then we'll do it together, and then so on and so forth. Okay. All right. So go ahead and work on that word here. Okay. So this first transaction, um, it's worth $16. So I'm just going to do the journal entry. And it's kind of, we don't have the full information to do the full journal entry, but um, it's basically going to be something like inventory, debit 16, credit, I don't know, accounts payable, something, cash, accounts payable. Okay. So the point is that we're using the total amount of the purchase in our journal entry. Okay, so this would be November 2nd. Okay, so November 6th, we're buying 2 more gallons. So this time they're $2.10. So one way you can do the formatting is just select all these cells, do it dollar, and now they'll all be kind of formatted the same. Oops. Okay, so now we have two different inventory layers, right? We have 8 of the $2 units. Again, let me just fix the formatting for these. And now we've added 2 more units at $2.10. And so the value of this inventory is $4.20. So after the second transaction, we have 10 units total worth $20.20. Okay. And of course, the journal entry for November 6th would be, exactly the same as this, you can say, except the numbers are different. It's $4.20, right? It's $4.20. So again, if we had our P account for inventory, we're going to have two debits, one for $16 and one for $4.20. And so this is going to reconcile with this $2.20. We have the same value in our accounting system, in our T account. Okay? Okay, so now we have a sales transaction on November 8th. Okay, so the question is, which 3 units are we selling? Are we going to take 2 from here and then 1 from here? Are we going to start from here and just take all 3? Well, it depends on our inventory costing method. We're using FIFO in this case. So we're going to start from the oldest, which are these 8 units, and we're going to start taking units from there. Okay, so in this case, we're selling 3. So we have enough in this $2 layer to do to cost the entire transaction. So 3, we're again taking them from the $2 units. And so my cost of goods sold is $6. Okay. What if we had sold 9, and if the quantity was 9 sold instead? Well, just hypothetically, we would have done 8 from here and then we would have to do 1 from the next layer forward. Okay, so but in this case, again, since we're only selling 3 units, we can take all of them from that $2 layer. So if we had 8 to start with here in this $2 layer, we're selling 3. How many do we have left? 8 minus 3 is 5. Okay, so we have 5 left. We still have all of our $2.10 units because we haven't sold those yet, or we haven't costed those, I should say. Okay, and you can see here, if we take this ending inventory balance plus whatever this inventory just sold, it reconciles to this total, right? Because we're basically, when we do cost of goods sold, we're taking our existing inventory and we're expensing some of it, okay? And so the total should be the same. Okay, so the journal entry related to this, we don't know how much we sold the milk for. We don't know what the sales revenue was, but at least we would know that the cost of goods sold was $6, and we would credit inventory $6. So we have a $6 credit here from the sales transaction. So now, just to be clear, our balance is $14.20, which is exactly the same as we have here. Okay? So again, I'm trying, is everyone very clear on how this table should be connected to your inventory balance? It's going to be connected to cost of goods sold. Your whatever is in that T account is going to be kind of calculated here. This is kind of like a detailed, like the details of what is going to go into your journal entries, and so they should align with each other. Okay, and especially like your inventory balance. That's like the one. It's kind of a running balance, so it should be always the same as what your T account is going to show. Okay, so now we have another purchase transaction. So November 13th, we're buying 2 more gallons at $2.20. Okay, so now we have 5 units at $2, 2 units at $2.10, and 2 more at this new price, $2.20. So my total inventory value, $18.60. Okay, and then we have one more sales transaction. Sold 4 gallons to our customers. So this is on November 14th. We're selling 4. And again, we're going to start at the back. FIFO is starting here. So we do have enough in this oldest costed layer to kind of fully account for this sales transaction. So we're going to, again, have $2. So we have cost of goods sold 8. We had 5. We just sold 4 of them. We only have 1 left in that $2 initial layer. And then we still have the rest of these. So our total value of inventory is this. The total amount of cost of goods sold is $14. And so that's kind of it, okay, for FIFO. So now I'll give you a hint, okay? For LIFO, this is going to be exactly the same, okay? Your purchase transactions, your costing method is not going to affect these numbers in any way. What is going to change is really this, and because of these two changing, this is going to change. Okay, so for LIFO, I'm just going to copy and paste kind of, at least, whatever is your purchase information, that's going to be the same. I'll give, so just, you can just use these exact numbers, but this and this are going to change, and then that's going to change, kind of the running balance of inventory. Okay, so go ahead, see if you can figure out how to do the same kind of concept. It's the same transactions, but now we're using a different costing method, LIFO. Okay, so go ahead and do that. Okay, so look, it's very, very similar. Okay, and I saw a lot of you are getting this, so good. We're gonna sell the same transaction is happening. 3 gallons are being sold on November 8th. So we need to have 3 units total here. But instead of starting from here and going forward, we're going to start in LIFO, we're going to start in the most recent layer first. So we're going to start at these 2 units. And since we're selling 3 total, we're going to kind of clear out these 2. So we're going to have 2 units at 210. The max we can sell is only 2, right? We only have 2 of those $2.10 units. So we're going to kind of clear that layer out and then move to the next newest, which is this first, there's only 2 layers. So we clear this one out as much as we can, and we move to this one. So we only need 1 more from this $2 layer because we're only selling 3 units. So the total cost of goods sold that we're going to have in our journal entry is $6.20. So, we would have, whatever, cash, sales revenue. We can't do this because we don't know what we sold it for. But then we'd have cost of goods sold, $6.20, and inventory, credit, $6.20. Okay, so again, the whole point of this table is really to calculate this using our whatever method that we're using. In this case, we're using LIFO. Okay, so once we have this, we can now update our accounting record or our inventory records. So we now have 7 of the $2 units, and 0 of the $2.10 units. I'm just writing that. You don't need to do that, but I'm just trying to be clear about what's happening here because we had 2 of them, but we sold them, right? These are the units that we costed because we're using LIFO. So we have just a total of $14 of inventory after this sales transaction. Okay, so now we're buying 2 more. So we're going to still keep this 7 at $2, but now we're adding 2 more at $2.20. Okay, so our total value of our inventory at this point is $18.40. And then we have our last sales transaction, which was 4 gallons. Okay, so it's a very similar thing where we need a total of 4. We're gonna start at this front. We're gonna start from the front and go back in LIFO. So we're gonna start with 2 at $2.20. And then again, we sold 4 units total, so we still need to sell 2 more. And the next layer back is the $2 layer. So our total cost of goods sold is $8.40. And so we have 5 of the $2 units, and then 0 of the $2.20 units. So just to be explicit here, and the total value of our inventory at the end of the period is $10. So let's just compare, okay? So we have a total of 5 units, the value of which is $10. If we look back up here, how many units do we have? We have a total of 5 units, right? So the unit count is the same, right? Because we bought and sold the same number of units in both cases, but we've just used a different costing method. So we're good with this 5 units. This reconciles. But the value of our inventory is different because we used a different costing method. So our total, just to be clear, if we added this up between our ending inventory plus the total cost of goods sold, $24.60. If we did the same thing here, it's the same amount, but look, it's split up differently. In FIFO, it's $14 total for cost of goods sold. Here we have more cost of goods sold because we were expensing the newer units, which were higher dollars per unit, right? $2.10, $2.20. So we ended up having a higher total cost of goods sold, but that leaves less in inventory, okay? $10 versus $10.60. But the total between the two is the exact same. We're just allocating it differently between cost of goods sold and inventory, between the methods. Everyone understand? Everyone good with this? So how many units do you think we'll have with weighted average life by the end? How many units total will we have? 5, right? It's going to be the same number of units. It's just going to be valued differently because we're going to now use a third inventory costing method. So this $24.60 is going to be split up differently in this third method because each method kind of splits up this total between cost of goods sold and the inventory differently. Okay, so the check you can do to make sure you did it right is to see if your ending inventory balance plus your total cost of goods sold is $24.60. It should be with weighted average. Okay, okay, so now again, it's going to be the same transactions. It's this part of it is going to be exactly the same. I'm just going to copy and paste this because again, the inventory costing method does not change anything about these purchase transactions. It's only going to be how cost of goods sold is calculated and therefore how the inventory balance is calculated. That's the only thing that the inventory costing method changes. Okay, so go ahead, take a couple minutes. Remember, weighted average is going to be the total value of the inventory divided by the total number of units. That will give you the weighted average cost. And for every sales transaction, you'll use that weighted average cost, but you'll recalculate the weighted average when you have a purchase transaction because now you have different number of units and a different total value of inventory. Okay, so try to see if you can figure this out, and we'll do it in a couple minutes together. Okay, so my claim is that you have to recalculate weighted average after every purchase transaction. Okay, so let's apply that rule. So the first one, I have only one layer. There's nothing to really average because this is the first transaction. So my weighted average cost is just the cost of these 8 because there's nothing to average it against. Okay, so it's quite easy. Like if I had a sales transaction that happened the next day, then I would just use $2 per unit. Okay, but now I have another purchase transaction on the 6th, and so this $2 is no longer valid. I have to recalculate a weighted average cost. Okay, so the way I would recommend doing it is figure out, first of all, how many total units do I have? So I started with 8. I'm buying 2 more. And then I figure out what your total value of inventory is. I started with 16 and I bought $4.20 more. Okay, so this is, you're kind of backing in to the unit cost with weighted average. Okay, so I start off with these 2 pieces of information, and that I can use is the total cost divided by the total number of units. This is now my weighted average cost. Okay, so now if I never did another purchase transaction, I would use this as a cost, as like, like whenever if I sold 5 units, or let's just do the next transaction. So I sold, what is it, 3 units? 2 units. Yeah, so no, 3 units. Okay, so I'm selling 3 units. All I do is use this weighted average cost for my cost of goods sold. And then I started with 10 units. I sold 3, so I have 7 left. I just use this. Same thing. Okay. And let's say I had another transaction where I sold 3 more units. I would just, again, put 3. It would be this, or like, let's say I sold 4 units, just to keep it a little different. I would use the same thing here. And then I would have 3 units left at the same value. Okay, so this $2.02 is the value I'll use for cost of goods sold until I have another purchase transaction. Okay, it's gonna carry forward until I have to reweigh or recalculate the average. Okay, so I only have to do that when I buy inventory for a new price. Okay, so I'll delete this. But now, again, as I said, the purchase of new inventory is going to trigger a recalculation. Okay, so in this case, I'll just do the same steps. What is the new total value of my inventory? It's this beginning balance plus what I'm adding, $4.40. How many units do I have? I had 7. I'm buying 2 more. Okay, so my weighted average is just the total value divided by the number of units. So $2.06. Okay. And then finally, we have a sales transaction, which was 4 gallons sold. I used this $2.06. Okay. And then I have 9 units. I sold 4. I have 5 units left. And I have they're valued at $2.06 per unit. Okay. So again, this should equal $26.40, I think. Let's see. Oops. What did I do wrong? Something. Oh, I know what I did wrong. So it's this plus this. So if we add these two up, the ending inventory plus the total cost of goods sold, again, $24.60, $24.60, $24.60. They all have different cost of goods sold. $14, $14.60, $14.30. Okay? And they all have different ending inventories. $10.30, $10, $10.60. But the total of cost of goods sold and inventory, the ending inventory balance, that total is the same. Again, it's just split up differently depending on what method you use. Okay, is everyone convinced of this? Yes? Okay, good. Yeah. Nothing. It's just to show that inventory and cost of goods sold are linked together. When you do cost of goods sold, you're taking inventory and you're expensing it, right? So however much you expense it by, if you expense it by more, then your ending inventory will be a little less, right? But the total will be kind of the same. Yeah. Okay, everyone good with this? Okay. All right. So let's take a break till 2, and then we'll just finish up the chapter. And I think we'll try to do another one of these practice problems if we have time, or at least as much as we can. Okay. So take a little break. All right. Well, we kind of just saw this, but just to state between these methods, we saw that there's a split between uh, inventory and cost of goods sold. Okay, so we assumed that if prices are rising, right? If we assume inflation, that LIFO is going to be expensing the more expensive inventory that you purchase first, and so that's going to make your cost of goods sold higher. If your cost of goods sold is higher, that means you're going to make your net income low. But if this is the highest cost of goods sold, because cost of goods sold and inventory are kind of seesawing with each other, if this cost of goods sold is the highest, that makes our inventory balance the lowest. FIFO is the opposite. The cost of goods sold, since it's using the oldest, least inflated, you can say, inventory, like the least inflation impacted. Um, I guess you can just relate it to the milk, right? We bought it for $2, and then $2.10, and then $2.20. With FIFO, you're gonna cost this $2 layer first, right? So it's gonna end up having the lowest cost of goods sold, which makes the net income higher because you have less expense. But then since the cost of goods sold is the lowest, it's gonna make your inventory balance the highest. Okay, so let's just check that against what we just did. So under LIFO, we had highest cost of goods sold and lowest inventory between the three. Let's just see. So LIFO had $14.60 is the cost of goods sold. FIFO had $14, and weighted average had $14.30. So yes, LIFO did have the highest cost of goods sold, and it's supposed to therefore have the lowest inventory. So $10 versus $10.60 versus $10.30. So yes, highest cost of goods sold, but lowest inventory balance was LIFO. FIFO is the opposite. It had the lowest cost of goods sold, but the highest inventory balance. And then weighted average was just in between the two. Okay, so that's essentially what this table is saying. Okay, specific identification varies because it's like you're gonna expense some high, some low. It's like you can't really say for certain because it depends on what specific items you sold. So you can't really say anything with specific identification. But between these three, again, assuming and the big assumption here is that the big assumption that makes this true is that prices are rising. Okay, if you had, what's the opposite of inflation? Deflation. Has that ever happened where prices go down a lot? Yeah, it definitely has happened. Okay, so in that case, this would all be reversed. Okay, weighted average would stay in the middle, but these two would flip. Okay, because again, your oldest inventory would be the highest value, right? You'd pay $2.20 first, and then it goes down to $2, and then $1.80 as time goes forward. So that's like a deflation. So that would cause the opposite effect as this table. Okay. Okay. But it's usually mixed. You know, we're seeing it in our world right now. What's been happening with oil prices? It's going up a lot, right? But before that, you know, this is not the first time in history that oil has hit $110 a barrel. It's happened like several times, many times. And then it just goes back down and it goes back up. So, you know, a lot of commodity prices are they fluctuate, you know, especially oil. Um, I guess metals, there's like, you know, maybe some definitely have a trend of just like going up over time, but there are some that fluctuate depending on supply and demand. Okay. So, you know, if it's mixed, then you can't really say between FIFO and LIFO what's going to be the case. If you have a constantly fluctuating kind of inventory, um, then it's going to be unclear which one is going to result in higher or lower net income. Okay, everyone good with this? Any questions? No? Okay. Okay, so the next topic, what happens when your inventory loses value? Okay, so uh, we have this principle that we've talked about, conservatism. We don't ever want inventory to be overstated. So inventory, we don't want it to ever be too high, higher than it should be. Okay, so in order to do that, we're going to be, you as a company have to make sure that the inventory is stated at a reasonable kind of uh, value that's justifiable. And yes, we saw choosing the costing method is going to change the value of your inventory, right? That's allowed, but it's this next thing of like, what if the true value of your inventory is just like you're holding it on your balance sheet at a value that's like not relevant anymore. Okay, so you are going to have to check that. Okay, so as per GAAP, you have kind of two terminologies: replacement value versus realizable value. So See, there's two different. This is kind of like a newer standard. I had to learn this because they've changed this. I don't know when, but probably semi recently. Net realizable value versus market value. Okay, so um, market value. Let's say you have uh, an inventory of I, iPhones. Okay, the market value is how much you can sell it to someone else for. The realizable or the replacement value, I guess that's the relevant term now. That's how much your wholesale price is. Okay, so there are two different values, right? What you sell the iPhone for to the retail customer is different than what you bought it for. Okay, so the standard is now, if you're using FIFO or weighted average, what you're going to check what you've said your inventory is worth is against the market value. Okay, so let's say you bought um, your iPhones for $200 each, and the retail price is $400. You do not have to take a write down if you're using FIFO or weighted average. Okay, let's say you bought them for 200, but now they're like so old. It's like the iPhone 4 or whatever. If you went and looked on eBay or like whatever, you could buy them for $150, right? That's like the market value that a retail customer is paying. It makes no sense that you're holding them in your inventory worth 200. Okay, you're gonna have to take a write down because you bought them at a time maybe when it was selling for 400, but now the market value has dropped, and you cannot hold it for $200. It's not worth 200, right? It's the best case is you sell it for 150. Okay, so you will have to take a loss of $50 a unit. Okay, if you're using LIFO, it's actually more stringent than that. Okay, so let's do the same thing. If you had bought it for 200, let's say the retail price is 350, right? So you could still sell it and make a profit based on what you sold or what you bought it for, but the wholesale price is 150, meaning how much you can buy it from a vendor in a large quantity, that has gone down. If you're using LIFO, you then have to use this. Instead of the market value, you have to use the wholesale value as your kind of determinant to see whether you should write it down or not. So the standard for LIFO is like more strict because they want to prevent these layers forming where you bought something like 10 years ago and it's still held in your inventory at some inflated value. Okay, so um, the standard is now kind of changed to this, where if you're using FIFO or weighted average, you're looking at the market value because you're assuming that the inventory value is more fresh, right? Because with FIFO and weighted average, you're kind of cycling through your older inventory. That value is kind of being dissipated over time. LIFO, you can have an old 10-year, old inventory value still lingering around on your balance sheet. And so that's why the standards are different between the methods. Okay. Um, so if you have the situation where your inventory has lost value, it's basically like shrinkage. Okay. You're going to debit cost of goods sold. You're going to credit inventory. Okay. So uh, now with numbers, see if you can figure out what the adjusting entry would be for this situation. So telling you that it's LIFO is actually relevant, because then what matters is not the market value, but the replacement value. Okay. So um, see if you can just do the math. Should be pretty easy. It's very similar to what we did with shrinkage. Who wants to help me with this? What is the debit? What is the credit? Yeah, Mohammed. What is that? Okay. And what are the amounts? 500. Okay. Yeah. Again, it's very similar to shrinkage. Your inventory unadjusted balance was 5,700. You're saying it's only worth 5,200. That means you have to credit it 500. Okay, everyone good with that? Okay. Okay. Okay, so this is actually uh, from Best Buy, from their annual report, and they're talking about their inventory accounting. Okay, so let's see what it says. So they record their inventory at the lower of cost or net realizable value. Okay, so um, basically they're using uh, the weighted average method. Okay, so uh, they're not doing it at replacement value. They're doing it kind of like, is the market value higher than what their inventory is? So because they're using weighted average, they're using the weighted average method to cost their inventory. So we now know what that is, right? Um, it includes inbound freight, right? So we talked about that in chapter 5. When we have purchase transactions and we pay for freight, we don't expense it right away. We include it in inventory, right? Everyone remember that? Yeah. Um, they also include reductions based on vendor allowances. So we talked about that. So now, this is all, it's not, everything we're learning here is not just, like theoretical. This is actually how they're accounting for their inventory. Okay. So all this stuff is being, we now know it. This is all just like the gap rules, but just by law or like whatever regulation, they have to state all this stuff in their financial statements. Um, what else is relevant here? Okay, so this is interesting. So the freight to move it into their distribution centers is capitalized. The freight to take it from the distribution centers to their retail stores is expense. Okay, so that's what it says here. Costs associated with storing and transporting merchandise inventory to our retail stores are expensed as incurred and included within cost of sales. Okay, so within cost of goods sold is that piece of freight between their distribution center and their retail stores. So, that's like, a little piece of information that is probably not so material. It's like, it's such a small percentage of the total cost of goods sold. But, it could be relevant. I don't know, depending on if you work for a competitor and you're trying to compare your business uh, against Best Buy and see how your margins stack up, this could be relevant. Okay. what else is relevant here? Yeah, so this is the last one. This is shrinkage. Our inventory valuation reflects adjustments for physical inventory losses resulting from, for example, theft. Physical inventory is maintained through a combination of full location counts and more regular cycle counts. Okay, so uh, they're just saying that they do an adjusting entry for shrinkage. That's essentially what that last paragraph is saying. And um, they have a perpetual inventory system. Okay, they're constantly maintaining their inventory, and they also do a physical count. Okay, where they'll physically go in and make sure that the accounting system is lining up with the physical. Okay, so uh, this is all just part of the GAAP rules and like just their kind of obligations as a public company to do all this stuff. But they're just saying it for this is like part of disclosure. Okay, they're just telling you everything explicitly. But if you are conversant with GAAP, you should know that this is like gonna happen. This is like part of the rules. They're just kind of restating what the GAAP rules are. Yeah.
The second paragraph, markdown adjustments, is that what we are talking about?
Yes. 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 Okay. Okay. So any other questions on this? No. Okay. Um. Okay. So this is like I don't know if there's a homework question on it. It's quite like a minor point. But it's in the chapter, so might as well talk about it. Um, if there's a mistake in your count of inventory, okay, um, that's going to affect your cost of goods sold, which is going to affect your profit, which is the same as net income, okay, or gross profit, which is going to affect your net income. So, uh, if the mistake is not systemic, meaning it was like a one-time mistake, you went in and counted wrong, it will actually fix itself over a number of periods. Okay, so let's just follow this example and see. Okay, so in this first period, what it's saying is that you basically overstated your inventory by $5,000. So this $15,000, you went in and counted your inventory. It should have been 10,000, but you said it's 15,000. Okay, it's just overstated by 5,000. So that resulted in um, basically a cost of goods sold that was, again, if inventory is too high, cost of goods sold is going to be too low. Okay, so that means if your cost of goods sold is too low, you're going to show extra profit. Okay, so this should have been actually 50K, right? So you're overstating it. But let's say uh, in the next period you don't make the same mistake, but this mistake from the last period is going to carry over. It's going to be your starting balance. If everything else goes the same and you kind of count the inventory correctly at the end of the next period, you're going to kind of understate this balance because you're basically going to have started the the period with inflated inventory to begin with, and so when you calculate cost of goods sold, it's going to be too high. Okay, because this is too high. Um, this is correct. If you just look at the math, it kind of self corrects. So the extra cost of goods sold that is added here, between these two, it kind of balances out. Okay, and why this is the case, it really has to do with the details of this math, where you take your your beginning balance plus additions minus the ending balance gives you the cost of goods sold. Because this mistake is carried forward, the math works out such that between these two, it kind of averages to the correct amount. Okay. Now, I guess knowing this is somewhat important. Just the math is kind of interesting, but like I don't know a realistic scenario where this would happen. Like this is just kind of a contrived thing in the book. Um, So yeah, I don't know. It's just a kind of cool math to see that it works out like that. Um, but really, if you had done the counts correctly, this would have been 50, this would have been 50, this would have been 50. Okay, so the fact that you're overstating this and understating this, it still averages out to 50,000 over the 2 years. Okay, um, so yeah, I don't think this is super important to know, but I think it is semi kind of cool that it corrects itself. All right, any questions on this? I don't think it's worth spending too much time on. So, um, but yeah, I guess what we can take away is this framework that we have here, where we have beginning balance plus additions minus your cost of goods sold equals ending. And what we're doing is solving for cost of goods sold. So it's beginning balance plus your additions minus your ending balance equals cost of goods sold. So again, we've seen this framework, and so it's just being applied in a different context with inventory this time. Okay. Okay. Everyone good with this? I don't think there's any homework question or anything. It might be in the DSM, but you guys have already done that. So, did this come up? What was the question in the DSM about this? There was none. There were. Does it make sense now? Yeah. Okay. Okay. And then finally, I think this is relevant. Inventory turnover ratio. So we talked about the banana in the store, um, and not only the gross margin being important, but also the amount of times you could sell that banana. So how do you calculate that turnover? It's the cost of goods sold divided by the average inventory. Okay, so let me just do this for our banana example. Okay, so my inventory value is $1, right? Because I said I can only hold one banana at a time, right? One banana. Okay. Now the revenue, the sales revenue that's going to be the driver for my gross margin, right? So if I sold this, so sales revenue $5, right? This is where the sales revenue, that's going to be the kind of important thing for calculating the gross margin. Because let's say I sold 10 bananas, I'll have $50 of revenue, and I'll have $10 of cost of goods sold, right? This translates to the sale of 10 bananas. Everyone agree with that? It's as if I'd sold one banana. It's going to be the same kind of margin calculation, $40, and it's going to be $40 divided by 50, which is the same as 4 divided by 5, right? So the gross margin calculation doesn't matter if I sold one or if I sold 100 or if I sold 1,000. It's going to be the same margin because it really just depends on how much I paid for one versus how much I sold one. Okay. So for the inventory turnover, though, instead of looking at revenue, we're going to look at cost of goods sold. So if I sold, uh, if my inventory is $1 and I sold 100 bananas, what's my cost of goods sold going to be? If I took that $1 worth of banana and sold it, after I sold it, I bought another $1 banana, and then I sold it again, and I kept doing that, right? So my ending inventory balance would still be $1 because I only can hold one banana at a time. But if I sold 100 bananas, what would my cost of goods sold be? 100, right? So what this is trying to see is cost of goods sold divided by your inventory is going to give you a sense of how many times have you turned that inventory over to generate sales. Okay, so in this case, it would be 100 over $1. This is my inventory of one banana. This would represent the 100 I sold, 100 sold. So that means that I turned over my inventory 100 times. Okay, so this is the intuition behind what this calculation is trying to get at. So you see how much inventory you hold at any, it's actually the average between the beginning and the end of the year, which is not accurate because like end of the year, you're gonna have like way more, right? It's like Christmas and whatever. There's much more retail that happens at the end of the year. And it's not distributed evenly over the year, like the fluctuations. So it's not quite accurate. But it's like, it's trying to get at some average inventory for the year. Okay, so that's what it's trying to achieve. So you take how much inventory you have and you compare that to your total cost of goods sold, right? Um, and the more times you're able to kind of cycle through your inventory over the year, higher the ratio is going to be. That means you had more inventory turnover. Okay, so um, another way to kind of conceptualize it is to take inventory turnover and so do 360 divided by the inventory turnover, and that's gives you approximately how many days the inventory stays in inventory on average. So if you have higher turnover, is the inventory going to be in inventory longer or shorter? Shorter, right? So that kind of, you can see that with this calculation. So if you had 365, let's say you had a business that had a turnover of 10x versus 365 over 5, right? This is going to be a smaller number, meaning less days versus this. Okay. So, you know, I don't know. I think inventory turnover for me makes more sense. I just like think of how many times you cycle through your inventory over the year. I think conceptually that like makes more sense in my gut than the days in sales, but they're essentially getting to the same idea. Okay, it's just you're just dividing a fixed constant by the inventory turnover, so it's really the same. It's the same number, but just stated in a different way. Okay, so let's look at some real life examples here. These are the inventory turnover for different businesses. RH is restoration hardware. What do they sell? Yeah, furniture. And what kind of is it like IKEA? It's luxury furniture. Okay, so you can see that the turnover between Costco, which is selling like food and like everyday items, is way higher than Restoration Hardware because Restoration Hardware is not making like super frequent sales. People probably go in there, look at stuff, chill for a month, just think on it, and then they'll buy it. Like the sales cycle is way longer. Plus, people aren't buying furniture every week, right? People go to Costco every week to shop. So you can see that the inventory turnover is much lower. But what do you think about the margins? Who has a higher margin, Costco or Restoration Hardware? Who has higher margins? I mean, like we saw luxury goods, right? It's very high margin. So it's just two different business models. Restoration Hardware is going to try to sell higher dollar price stuff and make more margin, but they're not going to have as much turnover. Costco has very low margins, but they're just cranking through a bunch of inventory every month. Okay. Now, which one is a better business? There's other metrics to figure that out, but they're just two different business models. So both can be successful. Okay. So the other thing, Costco and Walmart. Okay, I mentioned that Costco, it's almost once a month, right? This like you can say that their inventory turns over approximately once a month. If it was 12x, then that would be like kind of once a month, right? Every month it's turning over. It's approximately there. Now, I mentioned that they're able to basically order inventory from their vendor, and before they've even paid their vendor, they've sold the inventory. So they never had to really come up with the cash. They're getting the cash from the customer, right? So they buy stuff from their vendor, the vendor says, "Hey, you owe me $100 in 30 days." Costco will sell those items for $200, give 100 to the vendor, and keep 100. So they never had to finance the purchase of that because they're turning over inventory so quickly. Walmart is high turnover, but not as good. But they're still able to do this thing with the account payable because instead of turning over the inventory faster, they just tell their vendors, give me 60 days instead of 30. Okay. So they're just bullies to their vendors. They're still able to do that thing where they don't have to finance their inventory. They force the vendor to do that, right? The vendor is going to have to still pay their employees, pay their utility bills, and they'll have to borrow the money from a bank or something to do that until Walmart pays them. Okay. And Walmart has avoided having to borrow money from a bank. They're just borrowing from the vendor essentially. Okay. So it's good for Walmart, but not great for the vendor. But since Walmart is such a large customer for a lot of vendors, they just get away with it. Okay. Um, okay. Any questions on this? This concept of inventory turnover? No? Okay. And then one more topic that's in the chapter, periodic versus perpetual inventory systems. Okay. Um, in a periodic system, the inventory is not tracked in an accounting system continuously. So we talked about how businesses have their point of sale systems where they scan the item and they scan it when it comes into the warehouse, and they have a very sophisticated uh, inventory management system that's tracking everything kind of real time. Not all businesses have that. Um, like a small business, like a small retailer, they're not gonna maybe invest in that level of sophistication. And so maybe what they're gonna do is just do physical counts at the end of each period. And my family owned a Radio Shack, and we used to do this. This is like my job as like a seventh grader. I would just at the end of the month, I would be given a list. It was a printout of like how much stuff we have in inventory as per the system, and then I would just go and physically go to the shelf and count. And it was often like, you know, most of the time it matched up, but sometimes it didn't. Okay, so that's an example of a periodic inventory system. Okay, um, so uh, it is not as accurate as a perpetual. Um, and I'll show you a little example of why that is. Um, but you basically have a certain, like, it's like slightly different accounting. You're going to kind of track your purchases, um, and you're going to have your sales, and you're going to have your ending balance count at the end of the period. And between all these things, you're gonna get your cost of goods sold. And it's kind of like you're gonna put this here, you're gonna count this, you're gonna know how much you purchased from your vendor, and you're gonna use the beginning balance, which is the ending balance from the last period, and you're gonna use that to calculate this cost of goods sold. Okay, so it's kind of what I showed you in that last thing. Now let's talk about why it's like not as accurate as the perpetual. So we have these two scenarios. Um, we have a starting balance of 10 units, and each unit costs $5. We have a purchase transaction, and then we have a sales transaction. In this second scenario, it's the same thing, except the orders are reversed between these two. Okay. We first have a sales transaction and then a purchase transaction. Okay. So you're going to see that under the perpetual system, it's going to give you two different results, but under the periodic, these are going to give you the same results. Okay, so let's see. Um, so under perpetual, okay, so actually, well, yeah, do the calculation. This is, I guess, my intention here. Your job is to calculate what is the cost of goods sold and the inventory values in each scenario for perpetual and periodic. So under this, you're going to have some cost of goods sold and inventory for the perpetual versus periodic. and then the same thing here, okay? And you're gonna see, again, I'll give you a hint. You should see that under the perpetual, it's two different, uh, you'll have two different values, but the periodic is gonna end up with the same, okay? And they both use LIFO, so see if you can come up with that. All right, go ahead. Okay. 10 times? We're just adding. So you're starting with 10 units. You're buying 5 more. So how many do you have? You're not 10. It's not 10 times 5. It's 10 plus 5, right? It's like you have 10 cars. You buy 5 more cars, and then you're selling 3 cars. So how many do you have total at the end? 12. Okay, so we have 12 units in the end. Okay. So under the periodic, um, you're gonna have these 12 units valued at basically the first 10 are gonna be at $5, and then the next 2 will be at this. Okay, because we would have expensed the newest items first. Okay, so under periodic, it's gonna be uh 10 at, so 50 plus 12, so that's $62 inventory. And so what we would do is we take the beginning balance, $50, right? 10 times 5, plus your additions, which is $30, minus our ending balance of $62, equals our cost of goods sold, which is what? 80 minus 62 is $18 cost of goods sold. Okay, so $62 inventory and $18 cost of goods sold for periodic. For perpetual, um, you can kind of do, is that right? Yeah, I think it's this. Okay, I think we're on the right track. I just kind of scrolled down to see I didn't know it was so close. Okay, so for uh, periodic or for perpetual, we would have had a T account. I'm just going to do the T accounts. For $50 of inventory, the purchase transaction would have been 30, right? The inventory. And then sales transactions, 3 units. Our cost of goods sold, in that case, would have been taking 3 units from the latest one. So 3 times 6 is $18. I would have had a debit to 18 and this 18. So then what is it? 80. Yeah, so it's the same, 62. Okay, so in scenario one, our periodic and our perpetual give us the same answer. Okay, $18 cost of goods sold, $62 of inventory. Okay, now scenario two is going to be different because uh, under periodic, it's the exact same. There's no change actually. Okay, because we only kind of figured out that we have 12 units at the end, and we're going to basically start the valuation from the back, which is still in this case 10 units at $5, and then 2 units here, right? So those 12 units are going to be $50 plus 12. It's the same for periodic. Okay. Now the problem though is that in perpetual we are doing a real time kind of thing, right? So at the time of the sale, we have not yet even purchased these new items, right? So in the perpetual, it's basically going to be, we start off with 50 in inventory. This sales transaction, these 3 units, we cannot account for this because hasn't happened yet. We have to look at just at that time of the sale, what was in our inventory. Okay, so it's just these $5 units. So these 3 units, it's going to be cost of goods sold 15, debit 15 here, and then we buy these $30 units. So 80 minus 15, this is 65. Cost of goods sold is 15. Okay, so in scenario two, because the sales transaction happened before the purchase transaction, which is correct, I mean, that is actually the correct way. Like, that's more accurate. The perpetual system is going to give us a cost of goods sold of 15 and an inventory balance of 65. Okay, and again, the periodic is the same between these two scenarios because we're only looking at the ending balance. We didn't care of the order of things. We're just seeing what the net balance was in terms of number of units, and then we do our valuation based on the purchase transactions that happen. Okay, so that's not right. That's why a perpetual system is preferred, because it's not going to capture the order of things, which does matter if you want an accurate cost of goods sold. Okay, so let me just make sure that's right. Perpetual 65. Yeah. Okay. Yeah. So good. I did it right as per my last way of calculating this. Okay. So again, periodic, exactly the same calculations, because again, you're only looking at the ending, the beginning and ending. Perpetual, the order of the transactions will matter. Okay. Which that detail gets lost in a periodic system. So that's why it's like not as sophisticated. Okay. All right. Yeah. What else do I got to say? I think that's it. We don't have time anyways for anything else. Any questions? Any logistical